Today, I'm going to make the case that if you've been biding your time and waiting to buy a home in San Francisco, the time is now. Or, now-ish. And here's the thing, most people just think I'm full of it because I'm a real estate agent, and they'll tune out without even sticking around to see if I have a point. But that's your opportunity right there, because when people tune out is when you should tune in. So stick with me, and I'll take you through the market data and the easy math that bears out my case. So there are three main reasons why I think now is the time to buy. First, buyers are scared and sitting this one out. So you're not going to have a lot of competition for the home you want. Second, you're going to be saving a lot of money on the transaction itself that can go a long way in offsetting your increased monthly payments. And third, it's more likely that your equity appreciates more rapidly from here than it would have 6 to 12 months ago. Let's get into it. Obviously, there have been a ton of headlines about the Fed increasing interest rates and how that's driving up the rate a lender will offer you on a mortgage. Simplistic understanding is that as rates go up, monthly payments go up, things get less affordable. Fair, but the problem with that is that it assumes that prices are standing still, that sellers don't adjust to buyer budget erosion. Now, that's just not true. Lots of sellers need to sell, otherwise they wouldn't be selling. And sellers who have owned their properties for a bit longer may be less sensitive to immediate market dynamics, accept lower prices for their properties, and drive the market down once they do. Once market prices go down, so does the size of the loan you need. 80% of 100 is way smaller than 80% of 1,000. Not only does the loan size go down, but so does the amount of the cash out of your pocket in the form of your 20% down payment. Now let's look at the data to see exactly how much less you're going to be paying. I pulled down market data from the MLS on a weekly basis so that I can apply some custom analytical layers to it. And one of those is as close of a comparison on similar properties as I can get. So you can see here that we're looking at 3-bedroom single family homes. I'm looking across several different time periods, the past 2 weeks-ish, 2 weeks before that, 3 months before that, 6 months before that, 1 year or 2 year prior. And while the real data nerds out there will probably be able to point out a lot of places where I can improve, I can think of a bunch of places that I can improve. Directionally, we're getting decent information both on near-term and longer-term movements. And so what do we see? Well, the price of a single-family 3-bedroom home in San Francisco has come down since June of 2022. And depending on if you take the last 2 weeks or the 2 weeks before that, it's somewhere between 15 and 25%. Now, despite the fact that you're definitely going to see seasonal movement downwards towards the end of the year, fewer buyers are around during the holidays, all that kind of stuff, 15 to 25% is a huge discount. And the prices themselves, they're starting to get back to where they were at the end of 2020, which, if you remember, is the time where we were reading tons of headlines about the exodus from San Francisco. Everybody was fleeing to Texas and Miami and wherever they were going. So San Francisco prices really in earnest only started to come up kind of end of 2020 through the middle of 2022, really January 2021 when the season started through June of 2022. And you can see that that pattern is borne out here. So what does that mean for the money that you're saving? Well, if you come down to this line, if you come down to the cash needed versus the current or subject time period, you're seeing that you're saving anywhere between like $60,000 and $90,000 in terms of the cash that you actually need to put in at the time of transaction. So let's just say you're saving $60,000 in down payment, without even mentioning the additional like $3,000 or so that you're saving on annual property tax payments, given the lower price that you're paying. Now, what can you do with that $60,000? Well, you can put it into a no-risk treasury and earn 4.5% and put another $3,000 into your wallet every single year. Alternatively, you can just stash the $60K in the bank and pay off the difference in monthly payments you're incurring given the higher interest rates that everybody's talking about. So what is the difference? Well, when we come down here to this line that says total money and payments versus, again, the subject period, you're seeing actually that in June, you would have been paying $1,300 a month more than you're paying now. But if we go back to the end of 2021, you would have been paying $1,500 a month less. So remember, you saved $60,000 on the transaction. but you're paying $1,500 a month more now than you would have been at the end of 2021, given the fact that you would have been paying a 2.75% interest rate at that time. So 60,000 divided by 1,500, well, that's 40 months of banked difference in interest payments that you're saving by transacting right now versus transacting when interest rates were low, when everybody was telling you to buy and to take advantage of the interest rates. 40 months is 3.5 years. That is a ton of savings. Now, you've probably been pitched on this idea of marrying the price and dating the rate, and the theory that interest rates will go down over time, so don't worry about how high interest rates are now. Honestly, I think that theory is for chumps. Who knows what the hell is going to happen with interest rates? Who knows what the Fed's going to do? Who knows what banks are going to do? Just who knows? You shouldn't be underwriting on that kind of crazy, who knows what's going on, what's going to be out there, macro problem. You should definitely only be underwriting your home purchase on the reality in front of you. Now, interestingly, that reality in front of you is that as a buyer now, you're in a way better cash position than you were 6 months ago, 12 months ago, whatever it is, whenever interest rates were lower and everybody was saying, go and buy a house. Now, besides that, if you've ever listened, to any professional investor, which given the ubiquity of YouTube advice and Instagram advice, you probably heard a lot of them, they'll be telling you buy low and sell high, and that you'll never be able to precisely time both the bottom and the peak of the market. So what are we seeing right now? We're seeing a 20% discount that's rivaled only really by what we saw in 2008 when the entire global economy collapsed. And given that, it seems like we're much closer to the bottom than we are to the top. Now, while you can't ever tell what's going to happen in the future, what we do know is that we have really low prices that are super favorable to you. And those numbers are staring us in the face. The monthly payments are staring us literally right now in the face. So take what's in front of you. So that's my argument. 1, you're probably not going to have as much competition on the deal. 2, prices are way down. And 3, your savings will offset any money that you might be paying over your monthly payments that you would have paid before. So you know where I stand. I am myself actively making offers on properties in San Francisco as we speak. So I believe in what I'm telling you. Please, 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 please don't hesitate to reach out with any questions. You've probably seen my contact details stream across the screen, and you'll see them again in just a second. I'm excited to help. Let me know how I can.